Hi, I am Mr. James, and my mission is to help you prepare and perform at your best in your CSEC PUE or KEEP accounting exam using the power of video. In question 1A, we have before us Douglas Spencer reported the following amounts in the shareholders equity section of a December 21st statement of financial affairs. We're given some preference shares, common shares, and the share premium or capital in excess of par, retained earnings. And we are told that DS Limited took part in the following transactions concerning shareholders' equity. First one, paid the annual dividend on the preferred shares and a $2 dividend on the common shares. These dividends have been declared at 28 December 2013. So they were declared the year before and now they are being paid. So they should have been in a dividend payable account. Okay, so let's see. Prepared journal entries to record the transactions. Narratives are not required. We look at the workings first. The preference share dividend 200,000 by 10%, 10% up here, 200,000. We get 20,000. The common shares, we have 2,000 issued and at $2 a share for dividend, we'll get 4,000 in dividend, giving us a total of 24,000. When we do the journal entry, we can do it in total 24,000 or we can do it separate. Okay. The journal entry would be dividend payable 24,000, cash 24,000. Okay, it's payable. You must have the word payable here to get the mark. Because when you declare a dividend, you put it in a payable account until you pay it. Or when you pay it, you debit the dividend payable account. In the next transaction, issue 500 preference shares at 105. The workings would be 105 by 500 equal 52,500. Okay, this does not have any par value, so we cannot calculate any premium or discount on it. So your journal entry would be debit cash 52,500 and credit preference shares with 50,500. The next transaction, we received equipment with a market value of 77,600 for 7,500 common shares. Okay, the workings for that. The common shares is $100. The par value here is $100, and we multiply by 7,500, so we get $750,000. We are paying $750,000 for equipment worth 77,600. So it means we have a discount of 672,400 we are given to our new shareholders. Okay, so the journal entry would be to debit equipment, which we are buying with 72,600. Credit the discount on shares, debit the discount on shares with 672,400 and credit common shares with 750,000. Okay, now you have to be careful you don't mistake this discount for a premium. The last one is appropriated retained earnings for plant expansion, 200,000. Okay, so this is what it is. It's for plant expansion. You're not buying the plant, you're just appropriating the retained earnings. So you debit retained earnings, so take it out of there, and you put it in a plant replacement reserve of 200,000. Notice you have to have the word reserve here. If you just have plant replacement, you will not get the mark because plant replacement that could mean you have bought a fixed asset already. Part B, the National Gas Corporation sold 5,000 shares of Mango Pulp Company on 27th of March 2013 for $17.50 per share, including 1,590 in brokerage commission. The shares had originally been bought for $28. Prepare the journal entry to record the sale of the shares. Okay, so we have here some shares being sold at a loss and they're incurring a brokerage fee of 1,590, which will increase the loss. Right? Prepare the journal entry to record the shares. First, we do the workings. For the cash would be 1750 multiplied by the 5,000, right? And then you're going to pay 1590 from it. So that the cash you're going to receive on the transaction should be 85,910. Okay. Next, we have to work out the investment in mango pulp. Now, to do that, you need to know about investments. The brokerage fees is considered part of the cost of the investment. So when you pay this, you will in fact debit the investment in mango pulp company with another 1,590 dollars. Okay, so the original 28 per share would you would add on 1590 to it. So we got $28 by 5,000 shares will give us 140,000. We add 1,590 brokerage commission to it. We'll get $141,590. Okay, and last we need to work out how much the loss is, the loss on the disposal of the investment. The cost of the investment from here we get 141,590 less the proceeds from the sale of 85,910. We got calculated that up here and we get $55,680. Okay, so our journal entry, this is your answer here, should be debit cash in bank with 85,910. That's how much we collected for the thing there. Credit the investment in mango pulp with 141,590. This will remove it from the books, and we have a loss on disposal, the balancing figure here for 5680, which we had calculated over here. Part C. Give two reasons why it is necessary to develop IFRS for SMEs, 4 marks, and there are several institutes of chartered accountants in the Caribbean whose main function is to ensure that their members adopt and implement the international accounting standards, IAS, IFRS, or SMEs. Name one such institute for 1 mark. Okay, we look at the first part. It was necessary to develop IFRS for small and medium enterprises because the IAS themselves, the International Accounting Standards, were very bulky and some of them were irrelevant to the small and medium-sized enterprises. Okay, and secondly, because implementation of an entire international accounting standard can be too costly for an SME in relation to its benefits, right? So it didn't make sense implementing a full IAS. Okay, the second part, we have three Institute of Chartered Accountants here. They only ask for one, so you can choose, make your choice. Institute of Chartered Accountants of Trinidad and Tobago, ICAT, Institute of Chartered Accountants of Jamaica, ICAJ, and ICAB, Institute of Chartered Accountants of Barbados. The owner of McIntyre Enterprises is in the process of reviewing the procedures and practices that exist in his organization, and he has discovered the following situation, and they are numbered 1 to 6, and we are asked for each of the situations outlined above and using the format provided in Table 1 as an insert, identify the internal control that is being violated and suggest one corrective measures that could be employed and give your reason. Okay, 10 marks. Situation 1 has been completed for you as an example. Okay, we have the answer over on the side here. We'll go through them one by one. The store clerk hangs the key to the storeroom on a nail in front of his door. Then he goes for lunch. Okay. What control is being violated there? The physical is a physical control. Right? The hanging of a key. The key is a physical thing. So it's a physical control. And the corrective measure, the key should be handed to an authorized person when the storeroom clerk goes for lunch. Okay. And the reason, the person who holds the key to the storeroom can be held responsible for any intrusion or losses. Secondly, the purchasing manager is also responsible for receiving goods and maintaining the records of the goods received. The internal control that is violated there is segregation of duties. The corrective measure is to separate the person receiving goods from the person maintaining the records of the goods received. Okay, you must separate the recording from the custody of the asset. Right? It is easy. The reason is it is easy to falsify record and misappropriate asset if these two duties are performed by the same person. Then you have the company checks are not pre-numbered. The internal control that is violated is the documentation procedures, right? The corrective measure is to have your checks pre-numbered. So the reason is so that you can account for all your checks, right? If your checks have numbered and they go in sequential order, you will know when one is missing, and if you have accounted for all. If you have no numbers on the checks, you cannot tell whether a check is missing. Two cashiers use the same cash register. Establishment of responsibility. That is the control that is violated. We should designate one cashier to be responsible for a cash register. Only one person has to explain any difference in cash. That's the reason. Number 5, paid invoices are stored in the accountant's unlocked desk drawers. Okay, notice it is on lock. He doesn't lock his drawer. Again, you have physical controls. There's a physical desk with a physical lock in it that he could easily lock. All right. Uh, you should not have them there in the first place too. So have filing cabinets for storing accounting documents. All right, and you do that so you can improve reliability of your accounting records. Okay, if everybody can just pass and pick up accounting records and interfere with them, then the reliability of your accounting records would be affected. Number six, the cashier checks off the day's receipts and makes the bank lodgement. Again, we have the same segregation of duties, one person doing two things, and the control is being violated. Different persons should be assigned the tasks of checking receipts and banking. Only one person has to explain any difference between receipts and banking. Let's get right into it. The West Coast Eatery is a fast food restaurant that is operated as a partnership of three individuals. The three partners share profits equally. The following selected account balances are for 2012 before any closing entries are made. And we are given the capital of the three partners, Calvin, Sylvia, Leroy, and then we are also given their drawings and an income summary, profit or loss. Okay, and they share profits equally, we are told, so that's the profit sharing ratio for this income summary is another name for the profit and loss account. So the profit of the partnership would be 90,000. How we know it's a profit and not a loss? Uh, it's a credit balance here, right? A. Prepare a statement of partners' equity for the current year ended 30th September. Assume that no partner has made any additional investment during the year. Okay, so what they want is a statement of partners' equity. When I say equity, what you are looking at is the capital and all of the reserves. Okay, in a partnership, the reserves would be the current account. Okay, the current account is usually made up of how the share of the profits and the drawings. The share of the profits take the form of salary and interest on capital. In this case, we are not given any interest on capital or any salary, so just a matter of sharing the profit or the loss. I have prepared the statement of equity already, and we'll just go through it. We have three columns, one for Calvin, one for Sylvia, and one for Leroy. The capital at the start in first of October was 55, 60,000, and 5,000. We add the share of the profit, which is equally, so the 90,000 would be shared 30,000, 30,000, 30,000. And we add that together and we will get the capital before drawings and we minus their drawings 15, 15, 30,000 and we come down to their capital. Okay, so the final capital would be Calvin 70, Sylvia 75, and Leroy 5,000. Part B, assuming that Calvin and Sylvia spend the same amount of time in the business, why might Leroy be given the same portion of profits as the other two partners? Now you have to think about this very carefully before you answer, because we have two partners spending the same amount of time in the business as another partner, and he is receiving same amount of profit as they are, although he is only providing about one-tenth of the amount of capital that they are providing. Okay? After thinking about it, you could come up with something like this. He has special expertise and spends more time in the business than both of them. Okay, the special expertise especially. You can provide a little capital, and uh, because it is needed by the business, he gets a bigger portion of the profits of the other two partners. Part C, state three factors that the partners should consider when deciding how to distribute the profits of the partnership. First one could be interest on capital, and we will consider that because the capital differences between the partners. One partner may provide more than the others. In this case, the interest on capital, he will get a larger interest on capital, and that sort of evens it out. Then we have contributions to work, the amount of time they spend working in the business, they should be paid for it, uh, salary, and the salary should be about the amount of time they spend within the business. So those who spend more time will receive more salary. The areas of expertise. Some partners have expertise in a particular area that is needed by the business to serve their clients. These partners need to be paid for that, and it must become coming out of the profit. Party distinguish between corporations and partnerships in terms of the following characteristics. One, owner's liability for debts of the business. Two, transferability of ownership interests. And three, continuity of existence. We begin first with owner's liability for debts of business, partnership, corporation. In a partnership, partners are liable for debts up to their private possessions. There may be limited partners who are responsible for debts only up to their capital invested. However, each partner must have at least one unlimited partner. But in general, the partners are liable for debts up to their private possessions. Okay? The corporation shareholders are liable for debts only up to their investment or shareholding in the corporation. So they cannot lose their private possessions over the debts of the company. Transferability of owners' interests, partnership, corporations. In the partnership, you have admission of new partners, changes of partners' interests, and retirement of partners allowed. But each time one of these things take place, what happens is you have a new partnership being formed, and the old one ceases to be. In corporations, however, shares are easily transferable by sale on the stock exchange. Okay, so anyone can sell their shares by simply going to the stock exchange and getting a broker to sell it there for them. Continuity of existence in a partnership and in a corporation. The partnership is not continuous. The agreement continues until a partner retires, admission of a new partner, or a partner dies. Okay, as soon as any of these things take place, the partnership ceases to exist and either a new one starts or it comes to an end altogether. Corporation is continuous. Changes in ownership does not affect the firm since it is a separate legal entity from the owners. So the shares can change hands a million times. The new owners does not affect the corporation. The corporation still continues to exist and will exist continuously. until it is winded up. We are given some data here, and as usual, the first thing we should do is read what is required of us. Prepare a multi-step income statement in accordance with IAS 1, Section 6 at IFRS for SMEs. Right, next we start looking at the top. The new accounting clerk employed at Chin's Haberdashery, located at 27 Barnett Street, has made several errors in the preparation of the first set of financial statements. Below is the income statement she prepared for the year ending 30th September 2013. Alright, so we have here a statement of comprehensive income, and we are told that it is incorrect. It contains several errors. So our approach to it should be to go through and see what the errors are first, and then we will know how to correct it. The owner is convinced that he should not have made a loss and is worried that if he reports the loss to the non-revenue department, he will be assessed and the tax rate of 25% applied. He has asked you to review the income statement presented and make the necessary corrections applying the stated tax rate. Our stated tax rate here is 25%. Okay, so how we'll approach this is we'll go through the income statement and we will note what the errors are, and then we will present the corrected income statement. Okay, so we start at the top, and you have to have the name of the business at the top here. Okay, don't forget that. Chin's Haberdashery, statement of comprehensive income as at, and you give the date. It always follows the pattern who, what, when. Whenever you are doing a IFRS for SMEs or IAS 1 income statement, you should have your dates like that. Sales 230, and this is our first error here. Add sales returns and allowance should be less sales returns and allowances. Okay, and it should not just be sales returns but and allowances. When we were doing CSEC exams, we used to have only sales returns up here, and the allowances used to come down under here. The allowances is usually sales discounts and bad debts, increases in allowance for bad debts as well. Uh, Cost of goods sold, merchandise inventory on the 1st October. See, that look okay. Purchases, that's look okay. Purchases, returns, allowances, you have to minus it. Look at these two figures. Yes, they have minused it. And then we get the cost of goods available for sale, 166,994. So that we will less again. We have add where we should be minusing the closing stock, okay, of 54,800. We get the cost of goods sold, right? So we will think that this figure is grossly overstated. And when we take the sales and we minus the cost of goods sold, we will get our gross profit or gross income. And then we have the operating expenses. Now, according to the IFRS, only the operating expenses should be here. The wages is okay. Interest expense should not be there. That is not an operating expense. Supplies is okay. Freighting should not be there. Freighting is a part of the purchases and should be added on there. That is what you used to call carriage inwards in uh, CSEC. Sales discounts, Again, we said that's part of the allowances up here. That should be up there. The office equipment at cost, that goes to your balance sheet. Furniture and fittings at cost, that goes to your balance sheet as well. The depreciation of office equipment, that can remain. Interest income is not part of the operating either. You can take this and add it on to the gross income here, or you can add it on at the bottom here to the net operating income as other income. Depreciation for the 10 fittings that could remain under operating expenses, and then you have the total, you add them all together. You get your income from operations and net income when you minus the total from this year. And it should not work out to be a loss according to the owner. Okay, so let's take a look at the corrected comprehensive income statement. Your corrected income statement. Since Abadashri statement of comprehensive income for the year ended 30th of September 2013, you need three columns. This is a multi-step. And what I've done is I have put in the errors in a separate line or space, didn't add them on, so you can see where the correction is. Okay, but this should be added to this figure and one figure shown under here, right? Okay, so sales discounts added on to the sales returns and allowances, and we got 1,820. So your net sales is 228,180. From that, we're going to take the cost of goods sold, merchandise inventory, purchases, less the purchases, returns and allowance, and the freight in comes in here. Okay, the carriage in one. The cost of goods available for sale is the sum of these three here. Sometimes students forget about this one up here. They just add these two, so you be on your guard about that. And we will less merchandise inventory of 54.8 or minus the cost of goods sold 115,194. This minus this gives us 112,986. That is our gross income from operation or operating income. We look at the profit and loss section next. Income from operations. I have it here, but you should remember that it's one statement. You shouldn't have this figure twice. I just restated it because I could not get all to fit on the same screen. Here we have operating expenses, the wages, the supplies. Remember, it's only the operating expenses that will come under this heading, right? And depreciation and so on, you might be wondering about those. Those are operating expenses and normal business expenses, right? 2,500 and 4,000. We add them together and we get our total operating expenses, which we take from the gross income, and we get net operating income. The interest income, and we can take the interest expense out of it. So we get 740, and we can add these two together and get net income before taxation. Where our taxation would be 25% of this, which is 12,064. We get net income after tax of 36,192. So, okay. Now remember, when you are doing this, this line does not show in your statement of comprehensive income. I have added there for convenience sake so that we don't have to return to the other part of the screen. Okay? Share, like, comment, Part E. Name two users of the statement of cash flows and to state one reason why each user named would need a statement of cash flows. Okay. Two users would be bankers, trade unions, and there are many others, but we will focus on these two. Bankers need to satisfy themselves about loan repayments from the business, things like bank overdrafts and so on, but to extend them to the business and things like that. And then we have the trade unions who they want to ascertain the ability of the firm to pay wage increase. B. Classify the following list of items into the headings operating activity, indirect method, investing activity, financing activity, and significant non-cash investing and financing activity. First item we have is a loss on sale of fixed assets, and that will be classified as an investing activity. Issuance of bonds for land as a significant non-cash investing and financing activity. We will notice that the nature of the transaction here, issuance of bonds for land, that no cash passes there, the exchanging bonds for land. Conversion of bonds for common stock, again that's another significant non-cash investing and financing. You have bonds and common shares being exchanged for one another, no cash passes. Purchase of land, that's an investing activity. Redemption of bonds, financing activity. Payments of dividends, this can go under financing or investing activities. Depreciation, operating activity. Receipt of dividends on stock investments, investing activity. Right, that could also interest payments on bonds payable, financing activities, and issuance of common stock, another financing activity. Share, like, comment. The following extract from the Statement of Comprehensive Income of Margarita Company for the year ended 30th June 2010 is as follows, and we are given an abbreviated Statement of Comprehensive Income as well as two extracts from the balance sheet of 2009 and 2010. And we are asked to prepare the operating activity section from the statement of cash flow in accordance with IAS 7 IFRS for SMEs using the indirect method. Okay, so first we will have to do what we call the workings, and I will do it right here on this, indicating the figures which goes into the statement of cash flows. First, the beginning figure will begin with the income before interest and taxes, and that would be this figure here, 2,000, 5,000, since we do not have any interest. Okay, so our starting figure is 5,000, and there are two items here that does not involve a flow of cash, neither inflow or outflow. They are what we call notional figures, merely calculated and placed in the income statement. So depreciation expense is one of them, as well as the loss on the sale of equipment. And so we add those two back, and then we come down to the extracts on the balance sheet here, and the accounts payable, account accrued expenses, and so on. These are what we call working capital items. The changes in the working capital items is needed. So for the accounts payable, there's an increase of 7,000. The accrued in expenses increase from 7,400 to 8,700. Accounts receivable from 64,000 went down to 53,200. That's a difference of 10,800. And the inventory is 25,000 increase to 35,000. The tax payable we handle differently, and strictly speaking, that is not really a working capital item. Okay, what we want to find out is the tax paid. We take the beginning balance, we add to the amount in the income statement of 51,250, and then we minus the ending balance that we are still owing. What we will get there is the amount that we have paid for the year. Okay, we started with this amount, ended this with this amount. The movement between is merely 1,300, but actually we also have this amount here to put in. So it's $51,250 that would be added to the 7,2, and then we minus the amount that we have left to pay. So we get the amount that is paid of 53,950. Next, we will go into the cash flow from operations. Part C, the cash flow from operations. We start with the net income before tax and interest of 205,000. We add back the depreciation and the loss on sale of equipment for 76,000, and we get 281,000. We look at the working capital items. Now, at first, you would not know whether to add these or to minus these, but so there's a simple thing that I can tell you that will help you to get them out at first. The increase in current assets would be an outflow of cash. All increase in current assets is an outflow of cash, and that's all you need to remember. Right? It means therefore a decrease in current assets would be an inflow of cash, and you would add that. And then when you look at the other components of the working capital, the current liabilities, the increase in the current liabilities would be the opposite again, and then you have the decrease in current liability. So all you really need to remember is that an increase in current assets is an outflow of cash, right? So an increase in here, this one, for instance, is a current liability, and you see it's an inflow of cash, which is the opposite of the one that you have to remember, right? An increase in accruals, same thing. So we add it on. A decrease in the account receivable, right? 10,800. So we add it on. Increase in inventories, increase in current assets. You take that as an outflow and you minus the 10,000 in cash. The payment of tax is a payment, so obviously there was an outflow of cash 53,950. And when we add these together, we would get our cash flow from operations. If we had interest payable, we would put it in here as well. And we would treat it the same way we treated the tax. Take the amount from the profit and loss, add it on to the opening balance, and minus the closing balance. Okay, so that's how we handle this section of the cash flow from operations. Remember, all you have to remember is an increase in current assets is a decrease in the cash or outflow of cash. And from that, you can reason all the others. Here we move on to part D. Share, like, comment. Three limitations of accounting ratios. One, seasonal factors can also distort ratio analysis. Two, different accounting practices can distort comparisons even within the same company. It is difficult to generalize about whether a ratio is good or not. Part E. We have before us some selected data from the books of Hilton Bakery for the year ended 31st October 2010, and we are given some items from our income statement, and then we are given some formulas and therefore calculating ratios. What we are required: one, the gross profit margin; two, the times interest earned; three, earnings per share; four, price earnings ratio; and five, the dividend payout. And well, we have the formula here, so you don't have to rely on your memory. And the first thing you should have noticed here is that there's an important item here. This is not an income statement. There's some items from the income statement, and some important items are missing from it before you can calculate these ratios here. And if you look at it, you should be able to tell that the gross profit is missing, the net profit is missing, as well as other income and is missing. So if you jump right into the answer and you start calculating, you are going to calculate incorrectly and you're going to get wrong answers, no marks. Okay, so first we have to look at the working. So coming up next, the working. Now, one of the things we have to remember when we are doing ratios in particular is when we divide dollars by dollars, we don't get back dollars. What you get is a number of times. For example, if you divide $4 by $2, you do not get $2 as your answer. What you would get is two times. Okay. All right. With that, we take the workings for here, and I have reconstructed the profit and loss account here, the income statement rather. Sales, less the cost of sales, give us the gross profit. This was missing, and the other minus the other expenses, we get profit before interest and tax. This also is missing. The interest is 20, and the profit before tax is 166. This was also missing. Corporation tax 28, net income 138. Okay, then we go into the calculations. The gross profit percentage would be 300. From there over the 550, and we multiply it by 100, we get 54.5%. And then we have the interest cover, or the amount of times interest is earned. So we take the net income before profit and tax, before interest and tax, sorry, and 186, and we divide it by the interest itself, and we get, this is dollars divided by dollars, so we get 9.3 times. It means the net income covers the interest 9.3 times. And next we look at the earnings per share here. It's 138, the earnings, divided by 42,000 shares. So we get 3.29, $3.29 per share. Then we have the price earnings ratio, which is the earnings per share, the market price divided by the earnings per share. We get 2.43 times. And finally, the cash dividend divided by the net income multiplied by 100 is 18.12%. So these are your workings, and you need to make a comment on each one of them. So we're coming up with the comment next. Share, like, comment. So the first one we have here is the earnings per share, and what that tells us is that every share outstanding earned $3.29. Doesn't tell you anything more than that because you don't have a comparative income statement or the figures for another company or the industry. So all you can get from that is that every share outstanding earned $3.29. Next, we have the gross profit percentage. What it means is that for every $100 of sales made, $54.50 was profit before operating expenses. You must have this piece here, otherwise this other piece becomes misleading. Okay, it is before the operating expenses. 9.3 times for the interest cover. The profit before interest and tax covers the interest expense 9.3 times. Okay, nothing more than that it tells you. And 2.43 times for the price earnings ratio. It means investors are willing to pay 2.43 years or times earnings of a share for a share. Okay, so this is what investors are willing to pay on the stock exchange for your share. Then we have the cash dividend. This gives us the proportion of the net income paid out as cash dividend. Okay. Hope you learned something from this video. If you did so, I invite you to like it, or if you didn't, you can dislike it. Okay, and I look forward to seeing you in the next video.